And one thing we have seen is vicious outflows of money out of emerging markets into the dollar as well. How do you feel that goes in 2017? Are we going to see more of the same, or has the dollar run its course?
Well, this is it. I think for now we might see more of the same, but we certainly have the view that there's a lot of this already in the price. We're of the view that perhaps the reflationary theme in the US is overdone. First of all, we've got to remember that a year ago, remember, Obama signed in a huge fiscal package. I think it was about $305 billion a year ago. Have we seen the growth impact of that yet? Well, no, we haven't. We've got to remember, as I mentioned before, at this time a year ago, the market was of the view that the Fed could hike 4 times. That's what the Fed said. This year, we've seen 1 interest rate hike. Earnings, if we look at the payrolls data that we had at the beginning of this month, we had a minus 0.1 month-on-month movement in earnings data. That's 2.5% year on year. 2.5% when unemployment rate is this low, that's not necessarily normal. We would expect normally in an economic cycle to see wage inflation maybe at 4.5% at this point. We're not seeing some of those reflationary things coming through.
The market is against the story that you're talking about. So how risk on do you really want to be when the tide of momentum is against you?
Well, what I'm expecting is that for now we will carry on seeing some dollar strength, and the euro dollar could go lower, etc. But I think by the middle of the year the tide might have turned, because by then the market will have wanted to see a lot more action. It will have wanted to see a lot more strength in the economic data. It will have wanted to see the Fed moving again. And of course, if we don't do that, we're going to get disappointment again. And another thing to bear in mind is the amount of tightening we've already seen in the US. The dollar has tightened an awful lot. Look at the dollar index. Look at long-term interest rates. So there's already a lot of tightening there that will be acting against these inflationary pressures.
If you acknowledge that it could take 6 months to turn the sentiment around, does that mean you just steer clear of any emerging market currency that might be at the even riskier part of the spectrum at this point, because simply it's just too challenging to try and get any change in direction in the curve at this point?
I think possibly emerging markets are going to be certainly out of fashion, but I think it's very important to not label them all in the same way. Emerging markets are different, and I think investors will be looking at the fundamentals of each and looking at them in that way.
In terms of the oil price, though, as well, I mean, was the oil price leading the foreign exchange at any point in the last 18 months, 2 years, or was it always a factor of the foreign exchange, or a factor of the dollar as well? I'm just wondering, what's the tail and what's the dog at the moment on this pair?
I think there's a bit of a both, and obviously it depends what currency pair that you're looking at too. Obviously, if you're looking at Canada,
dollar oil is kind of one of these wonderfully easy trades. Dollar goes up, oil goes down. Oil goes up, dollar goes down. Apparently, you know.
I mean, in the last couple of months, I think probably the story's been more oil. We had the OPEC meeting in November, and then we had the non-OPEC with OPEC in early December, and so clearly those parameters were very, very important. Now I think the market is probably coming around to the point of view that, well, oil can't go up too far because we'll have an awful lot more shale production in the US, so it's naturally capped. And as long as there's a consensus around about that, then I think for now the market's going to be parking the dollar story relative to early this month when it was very much in view.